So as Dr. Sam Priyadarshi, which I will introduce just now, said, this felt like Trump walking into Motera Stadium, which he should be doing at this point of time, right? Should be happening. So thank you all. I just wanted to briefly introduce Dr. Sam Priyadarshi from Vanguard, US. Vanguard's one of the, if not the largest, funds globally, and he is a principal and heads their risk management, portfolio risk management for the group. Huge portfolio, over $140 billion, over $1 trillion of trading, or multiple trillions, I'm sure, of trading on fixed income securities. He brings insights into the fixed income market from the most developed market that we have around the world, which is the US. And we have the pleasure of having his presence and for him to share insights into how fixed income markets work. I know you have done some courses in finance in your year one. This would add to your understanding of this market, I'm sure. As by way of background, he studied in India. He's an engineer, and then his MBA from IIM Calcutta, engineering from BITS Ranchi, and an MBA from IIM Calcutta. Went on to do his PhD in the US at Virginia Tech, right? And so with that, welcome him once again, and pleasure to have you here.
Good morning, everyone, and thank you for having me. Thank you, Professor Swaroop and Professor Shekhar, for that kind introduction. I'm really excited to be here. So decades ago, when I was across the table in business school, I found lectures pretty boring, and I used to skip them all the time. But I did used to go for external speakers because I found them to be interesting, and it killed the boredom. So I'm hoping that you guys are not skipping your classes and attending all of them, and you are here not to kill your boredom. Now that the tables have turned, I want to share some of the wisdom I've gathered over the 23 years of being in fixed income markets. And the purpose of the session today is for me to give you an overview of the fixed income markets. And if you have ever borrowed money for a student loan, or for a house, or buying a car, or a scooter, you have been in the fixed income markets. Or if your parents have ever borrowed money or taken a loan, you've been in the fixed income markets. So these markets have been around for thousands of years. Governments or corporations would borrow money at a fixed rate of interest, and that's how bonds or debt or loans became commonplace. And now globally, the fixed income market is pretty sophisticated. It's actually bigger than the stock markets globally. It's more complex, but not as evolved or electronic as the equity markets. So we'll cover a lot of ground in the next 60 minutes, after which we'll have time for your questions. Now feel free to interrupt if you have any questions, because I want it to be a two-way conversation. But at the end of it, I hope you'll have a high-level understanding and appreciation of the fixed income markets. So my talk here is US-centric and developed market-centric, but you'll find a lot of commonality between the developed markets and the fixed income markets in India. So the content for today's discussion is we'll go through the fixed income securities and derivatives, and then we'll talk about the markets. We'll talk about trading venues, where actually these instruments trade, the systems that are used for portfolio management, order management, etc. And then we will talk about the macroeconomic research and credit research that goes into making informed decisions in the fixed income markets. So this is the market structure, which means we're going to talk about the issuers, who are the people that borrow money in the markets. We'll talk about who are the people that buy or give the loans, investors. We'll talk about financial intermediaries who make all this happen. And briefly, we'll touch on regulations. So the issuers of debt, they are essentially borrowing money from the markets. And they're borrowing for a set term, like 5 years or 10 years or 30 years at a fixed rate of interest. And that's why it's called fixed income market, right? So for example, in the United Kingdom, Her Majesty's Treasury might borrow 100 million sterling for an interest rate of 4.45%. Or in the US, the Treasury Department, the US Treasury, may borrow $5 billion for an interest rate of 1.5%. And the rates globally are pretty low compared to emerging markets, and there's many reasons why. The kind of issuers are sovereign, so the governments of different countries, like the government of India or the government of China. So those are called sovereign issuers. Then there are supranationals, like World Bank and so on. There could be corporations, like companies that operate in the market that borrow money. And then there are structured finance papers that are a combination of different types of debt. And then investors are retail. Retail investors are not that active in fixed income markets, but institutional investors are massive. They are the big investors in the fixed income markets. And then there are institutions such as banks, asset managers, hedge funds, pensions and corporations and endowments that invest in the fixed income markets. The financial intermediaries that make all the transfer of debt between the issuers and the investors happen, they are dealers and brokers and exchanges and clearinghouses. And then all of the entire marketplace is heavily regulated in the US and globally. So in the US, we have the SEC, Securities Exchange Commission, Commodities and Futures Trading Commission. In the UK, it's the Financial Conduct Authority and so on. For example, in India, the markets are regulated by SEBI. So it is a massive market, and we'll just briefly look at the size of the market. So we will now talk about the different kinds of cash securities. By cash, I mean these are like underlying securities. And there's sovereign debt, as I said, which is the national debt of a government. And you can have US Treasury issuing bonds in US dollars. You can have UK Treasury issuing gilts and Japanese government bonds. And then you have agency debt, which is government-sponsored agencies issuing debt. You can have supranational debt issued by World Bank, IMF, European Bank for Reconstruction and Development. And then you have corporate debt issued by companies like Google and Amazon and ICICI, et cetera. And then you have municipal debt, which is very popular in the US, which is debt issued by schools, universities, state and local governments and municipalities. And then you have structured finance, which is kind of bundling of different types of debt, like asset-backed paper, credit card debt, auto loans, and so on. And finally, you have money market debt, which is short-term debt shorter than 12 months, like treasury bills, commercial paper, or commercial deposits. So this market is called the cash market, which is different than derivative market, which is market which draws its value from the cash markets. So it includes futures, swaps, and options, and futures are kind of derivative instruments on sovereign debt. So for example, US Treasury futures are futures that the value is derived off of US Treasury bonds. And you have gilt futures, which is again futures based on UK gilts. and JGB futures, which is Japanese government bonds futures. And they trade in trillions of dollars every single day. You also have interest rate swaps, which are arrangement to exchange cash flows, fixed versus floating, or floating versus floating. They're typically indexed off of LIBOR benchmark, which is going away in a couple of years, and it'll be replaced by different alternative rates. Then you have credit default swaps, which are essentially insurance on issuers staying afloat or not becoming bankrupt. So if you want to buy protection on bonds not defaulting, then you enter into credit default swaps. And then you have currency swaps, which are FX forwards and FX swaps. So those are the swaps in fixed income markets. And then you have options, which are options on interest rate futures and caps, floors, and swaptions, which trade based on the volatility of the underlying instruments, including the cash instruments. So the global fixed income market is pretty big. The total size is $85 trillion, so it's massive. Almost half of it is issued in the US. So roughly $40 trillion is issued in the US, followed by Japan, which is 12.7 trillion, and the UK is 5.8 trillion. Of which the US government makes up about 40% of the government debt, which adds up to $43 trillion. Okay? So globally, sovereign debt is 43 trillion, and the US has issued debt in the amount of $18.9 trillion. And followed by Japan, which is 9 trillion, and UK, 2.7 trillion. So why do governments issue debt? Why do they borrow money? Anyone? Sorry? Yeah. Where do they get money from? Governments, where do they get money from? Sorry? Taxes. And where do they spend money on? Sorry? So they spend on defense and education, healthcare, and so on. But if they have to build airports and dams and massive infrastructure, they have to borrow money, right? So that's what's going on across the globe and in India too. Then there are financial corporations, like everyday companies, same thing. They're selling products, they're spending on salaries and buildings and whatnot, but they also have capital needs. They're building factories and so on. So they're issuing debt to finance that, right? And again, the US financial corporations like investment banks and commercial banks, they are the largest issuer of corporate debt in the US, followed by Japan and UK. And then there are non-financial companies like Google and IBM of the world that they issue corporate bonds, right? Let me understand your question. This is the outstanding debt stock in the world. That's the amount of outstanding debt, yes. Not derivatives, right? Yes, yeah, we'll come to derivatives shortly. So this is the amount of, the question was, is this the amount of debt outstanding? And the answer is yes. So roughly $85 trillion of debt outstanding in the world. Sorry. Now we'll talk about, briefly talk about investment styles. So there are two distinct styles of investment. One is active and the other one is passive. So active is trying to beat a benchmark. So you are given a benchmark and you're trying to outperform or have a performance which is superior to the benchmark. And then the other style is passive, which means you're just trying to mimic the returns of a benchmark or an index. And roughly speaking, passive or tracking an index is about 25% of the market. Okay. And then the 75% is active management. And active management is done by, there are two flavors of active management. One is buy and hold. So you just buy the paper and buy debt and hold on to that until it matures. And that's typically popular with insurance companies and pensions. The other style is you're actively buying and selling bonds, not just holding it to maturity. And the idea is to have a total return or beat your benchmark. And like I said, passive investing is just tracking an index. In the US, there are certain indexes which are called Bloomberg Aggregate Bond Index, and the idea is you're just mimicking the index to earn the returns from the index. And then you could also have different types of funds based on the term of the investment. So you can have money market funds, which are shorter than 12 months. You could have short-term bond funds, which are roughly 1 year to 3 year. You could have intermediate term funds, which are 3 to 5 year. Or you can have longer term portfolios, which are long-term bond funds. Another aspect of this is whether the bonds are taxed on the income and price appreciation, or there are certain types of bonds which are municipal debt. They are not taxed. The interest income is not taxed, so you still have to pay taxes on the price appreciation. And those funds, they're called tax-exempt funds. And they're a small part of the fixed income markets. Largely all the debt issued in the US and globally is taxed, both for income and price appreciation. And then there are different types of risk profiles of these funds. So you can have investment grade funds, which are high quality funds, or you could have high yield funds, which yield a higher rate of interest, but they have more risk associated with them. So now we come to portfolio management. So portfolio management is when teams of traders, analysts, credit analysts, macro economists, and portfolio managers manage portfolios. So this is what they have to contend with. So they have to look at macro and external factors, what's going on in the economy, world at large, in terms of economic numbers and data and news. So they have to understand what's happening with interest rates. Are interest rates going up or down? So they monitor rates intraday globally. They try to understand credit, which is the credit worthiness of issuers. So are issuers good for the money that they have borrowed? Will they return the money in due time? And that's called credit. They look at FX or foreign exchange markets, and they look at the volatility in all these in markets, like in rates, credit, and FX. And they also look at the amount of new debt issuance or the stock of bonds. And they look at the global economic picture in terms of what's happening across the globe in different countries. They also look at geopolitical factors, such as what is happening in the world right now, across the world, different things happening. For example, right now you may have heard of the pandemic in China. So all those things affect the markets and in real time. Okay? And then they have to comply with portfolio guidelines, which largely are internal, how the portfolios will be managed. So they have to comply with the internal guidelines, investment guidelines, and they also look at the benchmarks, which is dependent on duration and sector allocation. Then there are cash flows coming in terms of the subscriptions and redemption. People are buying money, sending you money to invest. So those are cash inflows, and there are people taking money out. Those are redemptions. So subscriptions and redemptions. But you also have money maturing, the money that you lent out by way of buying bonds. that's maturing, so that's money coming back by way of principal, and you also are earning interest, periodic interest. Typically, in every market has its own convention. In the US, interest is paid semi-annually, every 6 months. In Europe, it's paid annually. And on top of it, you have an overlay of active management or overlay strategies, both strategic, could be long-term, or tactical, which could be intraday or intra-week. And then you could have different sectors being overweighted or underweighted, or different securities itself could be overweighted or underweighted. Okay. So the portfolio manager's job is to understand what is driving the markets, how are the markets changing, and they want to understand that because of two reasons. One is to understand how the portfolio's value will change, and the second thing is how to position their portfolios today or tomorrow or in the future. So what impact will it have to my current portfolio, and how to construct my portfolio going forwards. And they look at different macro drivers, including monetary policy of the country they are in. For example, they might be following the European Central Bank's monetary policy, or the fiscal policy of the government that they are. What is the fiscal policy of India? So they're trying to understand what's the government trying to spend money on. And they'll try to understand the geopolitical events around the world and in their country, economic growth, GDP growth, and the different numbers. So they're looking at numbers all day long. They're monitoring all these numbers in real time on their screen. They try to understand the employment markets, wage growth, the the percentage unemployed, and so on, trying to gauge a sense for the labor markets. The portfolio managers look at the inflation expectations, how the prices of consumer goods and producer goods, how will they change. And they look at the credit fundamentals of the companies they're invested in. Like, are the companies doing according to plan, financial plan, or they're falling behind. And then they look at the credit worthiness of the issuers. The credit ratings are a big component of the fixed income market. So each issuer has to get a rating on their debt that they're taking, and it's typically done by credit rating agencies, including Moody's and S&P, etc. And these are like letter ratings like A, B, C, D, etc. So the highest rating is AAA, the lowest is default like D, and so on. So the portfolio manager's job is to try to understand the credit rating of debt and the future path of it. And then they look at the earnings and financial statements that are issued by the issuers. So by regulation, all the issuers have to do regulatory filing of their earnings statements and financial statements, the amount of debt outstanding, and the interest rate, debt service coverage ratios, etc. So they're trying to look at all the numbers to understand how their portfolio might perform. They also look at the impact of market performance of FX and credit and commodities as they correlate to each other. And the markets are highly correlated. What happens in one market affects the other market. Okay? And now we turn to talk about trading venues. So where is all the debt being traded, all the bonds that are being bought and sold? So there are two different venues. So one is over the counter, and the other one is exchange. So an exchange is like, it's an electronic market where buyers and sellers send their orders electronically, and the buy and the sell is matched electronically, and that's an exchange. And these trade trillions of dollars every single day on the electronic exchanges. Everything outside of that is called over the counter. So it's typically done by phone or on computer-generated messages or computer trading screens. So over-the-counter instruments that are traded are US Treasury bonds, agency bonds, corporate bonds, and some fixed income derivatives. And largely dealer-to-dealer market or dealer-to-client trading happens on over-the-counter markets. It can also be on an electronic screen. No one really picks up the phone these days. They just do everything electronic. And like I said, exchange trading is generally matching, computer matching of buys and sells. And there's a lot of screen trading in not just the fixed income markets, in all capital markets, it's a heavy amount of screen trading. And Bloomberg is a big company that provides terminal services across the world. Traders and portfolio managers use Bloomberg trading screens to trade US Treasuries, agencies, corporate bonds, and swaps, etc. Some other trading platforms are TradeWeb and Market Access. And we'll look at some screenshots later.
What's the difference between exchange trading and screen trading? What's the difference between exchange trading
Yep,
and screen
I understand. Great question. So exchange trading, you cannot physically go to the exchange and buy and sell. You have to send your order electronically via a computer. It goes to the exchange. So suppose you're buying something, so the order goes to the exchange and someone else is selling. They also send their order and it matches. Electronic trading or screen trading is different. So you send a sell order and you reach out to 4 different dealers and they receive your sell order. So they'll send you prices and you can decide which one. I'll show you screenshots in a little bit. So we'll now look at derivatives trading, which was, I believe, your question. So the cash market, which is the blue circle, is $85 trillion outstanding debt. Derivatives is notional outstanding is 594 trillion. So massive amount of derivatives outstanding. And the value of derivatives is derived from underlying instruments. The futures get their values from rates, commodities, and FX. And forwards, again, from rates, commodities, and FX. We talked briefly about swaps and options, which are also rates, FX, credit, and inflation. Yes, sir?
So given that the proportion of derivatives based on debt that is right now, if this size keeps on increasing, is there a risk of 2008 repeating itself? Volume increases.
So after the crisis, a lot of regulations were passed because the market regulators were concerned that the derivatives market was outsized that of the cash markets, and they put in place very stringent regulations regarding the trading, clearing, reporting, and regulatory oversight. So you cannot preclude another financial crisis from happening, but the chances are diminished. But it's a great question. I mean, you can see it's nearly, 7 times the size of the cash markets. Most of these derivatives trade on organized exchanges, just like we talked about, primarily for futures. And trading is regulated by the exchanges. In over-the-counter markets, all of the derivatives that are not traded on exchanges, they trade in over-the-counter markets. Okay? And they are subject to bilateral agreements or documents called ISDA documents. And then the uses of derivatives are in risk management and managing your tail risk, like that your portfolio doesn't collapse under some political risk or something happening to rates, credit, and FX. And then also for implementing tactical or strategic overlays. So I'll show you next a video of my team and how we use derivatives.
The world is a complex and challenging place, especially for investors.
People need the safety and security that their money will be there when there is uncertainty in their financial future.
People work hard every day and they save money for retirements,
Right.
for the purchases of homes, for college. It's important to have people to guide them.
Indeed, Vanguard is one of the world's largest investment management companies, and we manage over $4.4 trillion in global assets and offer 360 funds to over 20 million investors worldwide. And we have teams of strategists and economists, and we use combination of cash, treasuries, and futures and swaps to hedge our portfolios.
So you're vigilantly watching the markets, acting as a steward of your client's money.
People come to us because they trust us. Vanguard's core purpose is to take a stand for all investors, to treat them fairly, and to give them the best chance for investment success.
In order to manage your client's money, you need tools to manage the risks associated with each of the different asset classes. Over the last several years, there have been huge changes within the financial markets and huge increases in efficiencies. Investors can rely on CME Group to develop new products and new tools to navigate risks in more and more efficient ways every day.
We use futures that are listed on the CME to hedge our portfolios against geopolitical risks, macro events, and an uncertain marketplace that is always evolving.
CME Group futures and options are some of the lowest cost, most efficient, most liquid instruments you can use to enhance returns and protect those investors who've trusted you with their money.
That's right. New products that are listed on the CME are beneficial to our fund management, risk management, and liquidity management processes. And clearing at CME has really brought down systemic risk and reduced counterparty exposure. All of these have benefited our shareholders.
Sam, everybody faces challenges as savers today. Retirement costs are going up. College costs are going up. And the global marketplace is as uncertain as ever.
It's an increasingly complex world, but we will be there for them every step of the way. The futures and options that are listed on the CME are a vital tool for how we manage the money for our shareholders.
And investors can rely on CME Group to work very closely with you and with Vanguard in order to meet.
All right, that was the gist of it. So let's go back to our presentation. So now I'm going to talk about the different investment management systems that companies use. And the first of these is the portfolio management system. So it is a system which connects the portfolio managers, traders, analysts across the world and in real time. So we monitor all the cash flows coming in throughout the day across the globe. We are monitoring the risk in real time, and it allows the PMs, traders, analysts, and senior executives across the globe to manage the portfolios in real time. It's a pretty complex system. Actually, generally there are 3 or 4 vendors that are prominent in providing portfolio management systems. Then there is an order management system. So traders across the globe, they are raising buy and sell orders in cash, fixed income, as well as in FX and derivatives. And there is an entire workflow of portfolio construction, order generation, sending it to a trading venue electronically, and that coming back into the order management system and then flowing back into the portfolio management system. These are pretty complex investment management systems. And finally, there is execution management systems, which are trading screens, trading venues, and exchanges. Okay. So now we turn to talk about macro research, or what the portfolio managers and analysts try to understand will change in future, in short-term future, that will impact their portfolios. So they look at the rate setting done by the central banks, such as the Reserve Bank of India, and the buying and selling of bonds done by the government itself. And why would the government buy bonds and sell bonds itself? Like the United States buys its own bonds. Why would they do that?
Create a stimulus package, but at the same time to control the inflation effect that might result out of that.
Absolutely right. They do that, they buy and sell to control the interest rates. So not only do central banks set policy rates, monetary policy rates, but they also buy and sell bonds to affect the interest rate in prevalent in the market. So that the buying and selling in the US is done by something called Open Market Committee. I don't know what the equivalent is in India here, but different countries have different departments that do the buying and selling. And they also impose reserve requirements on banks, which will drive the amount of liquidity in the markets. Um, so we have a team of economists. Most companies have a lot of economists sitting with us that are looking at numbers all day long. So they look at GDP, GDP growth, personal consumption, inflation numbers like consumer price index, um, producer price index at the cost of manufacturing goods and services. They look at labor markets, unemployment rates, and jobless claims, payrolls, increase in wages, and so on. They're monitoring. All these numbers are pretty high frequency economic data that come from all over the world. So my team of portfolio managers and traders, they're investing globally. They're not just investing in US debt. They're buying debt in UK and in Europe, different countries in Europe, Spain, Italy, Germany. They're buying debt from Japan and Australia, and actually they're buying from India too. So they're buying debt globally. So they're monitoring economic data from all over the world in real time, because numbers keep coming throughout the day. So they're monitoring these numbers. And they look at different business conditions like uh, purchasing manager index number, PMI number. They look at the different central bank communications. They call them central bank policy, or the outlook on the economy from different markets in the US and globally. They look at housing markets, so they look at home price indexes and real estate market, how is it trending. They also look at retail sales, auto sales, and so on. Then they look at consumer confidence, how is the sentiment of the consumer, how is it going to impact the portfolios. And they look at external account and current account and trade balance numbers. Then we turn to from macro research to credit research. So credit, as I mentioned, can be specific to the issuer that has issued the bond. Okay, and there are different sectors. So there's financials, which includes banks, insurance companies, and life insurance companies and health insurance companies. So that's the financial sector. Then there is the industrial sector, and there are like 17 different subcategories of industrial corporate debt issuers. So they could include chemicals and metals and mining, paper, home, transportation, etc., etc. So we typically have credit analysts that focus on one sector. So A transportation credit analyst is just focused on airlines and um, uh, automobile sector. So they're just focused on companies in that sector. And they typically handle like 30 to 40 companies in that sector. So they're monitoring the financial performance of the companies in that sector. And then we have another broad class categories in utilities like electric, natural gas, um, the pipelines, and so on. So again, credit analysts that monitor companies in that sector. And then you have non-corporate sectors. We talked about supranationals like World Bank, IMF, Asian Development Bank, and so on. And then foreign agency and foreign local government bonds. Another type of credit research analysts are those that understand structured finance, like asset-backed securities, home equity, and utility loans. And the last category is municipal. So debt issued by state and local governments, universities, schools, etc. And they are the non-taxed sector in the at least in the US. We have municipal analysts that try to understand those sectors like healthcare sector and so on. And next I'm going to show you some screens that this is from my computer screen. So this is what I look at and my team looks at every single day. And these numbers that you see here, they keep changing. They're changing in real time. Like you have to really monitor them. So it's very hard to read, but the first panel on the top left is where I'm monitoring rates across the world. And the top part is Americas, the second part is Europe, Middle East, and Africa, and the bottom part is Asia. Not in particular order of importance. I have to monitor all of them. And then they are the benchmark securities, like 10-year rates, and how is it changing in real time. The, the top right chart is the credit, like the spread of issuers that have issued bonds. And that's different sectors that we talked about, chemicals and transportation and so on and so forth. So I'm monitoring the spread to government benchmark rates, and that's where I'm monitoring the credit markets. And in the bottom uh, left panel, I'm monitoring the FX rates across pairs of currencies. Um, there are currency pairs, so there's those different flags that you see: USD, US dollar, euros, Scandinavian countries, and sterling, Swiss francs, etc. And I'm monitoring the currencies. In the bottom right panel, I'm monitoring what's happening, what are the market movers in each of those sectors. So equity, um, foreign exchange, sovereign bonds, commodities, and credit default swaps. Okay. And right now it's all stagnant, but or stale, but in real life it keeps flickering. So, and this is all the trading screens that someone was asking. These are the different trading screens. So this is an exchange. The top one is a direct feed from the exchange. So I can see the buyers and sellers. It's an anonymous. So I don't know who the buyers and sellers are, but I can see the prices that are happening in the exchange. So this is a direct feed to the exchange. The other screens, they are over-the-counter markets. So these are all electronically traded over-the-counter instruments. The second one is for trading interest rate swaps. So I'm creating an order ticket and I'm sending it to the swap exchange facility, and I'm going to get prices from my counterparties, and then I'll decide which price to buy or sell at. Obviously, I'm going to pick the best price. By regulation, I have to pick the best price. The second one is for trading bonds, and this one is for trading a list of corporate bonds. So it's called a buy list or a sell list, or it could be portfolio list, which is combination of buys and sells. This one, very hard for me to read what that is. So this one is also a list of all the bonds I've traded that day. And that is actually a picture of my desk. It shows the different screens that I'm monitoring, and and my phone system. Actually, this happened during the World Cup, so I was also monitoring World Cup. Yes, they're traded on regulated swap exchange facilities. They're not exchange traded, but they're electronically traded, and that's the screen in the middle, top middle. They're exactly. They're over the counter, but traded on regulated entities. Okay, I'll show the last video, which is a tour of our fixed income trading floor.
Hi, I'm Katie Rieger, Senior Product Manager specializing in fixed income products and formerly a trader on this very floor. I'm here today to give you a quick tour of our fixed income trading floor, while also giving you a peek behind the scenes of how we manage fixed income at Vanguard. While Vanguard has been managing active bond funds for nearly 4 decades, many investors only know us as an index manager. We like to think of our active capabilities as the best kept secret at Vanguard. The fixed income team includes more than 175 investment professionals, not only here in the US, but also in the UK, China, and Australia. Having teams throughout the world lets us tap into local expertise that's critical to our fundamental approach to the bond market, and it allows us to trade during times of the day when market conditions are most favorable. This is also a deeply experienced and talented group. More than a third of our investment professionals are CFA charter holders, and just as many have MBAs. Our senior leaders average more than 20 years in the industry. This highly qualified team is responsible for managing over $1 trillion in assets, making us one of the largest bond fund managers in the world. We have roughly $600 billion in assets in our active fixed income products alone, including our money market, municipal, and active taxable bond funds. Having a large and global team allows Vanguard to leverage deep expertise across the fixed income markets. On the trade floor, specialist traders, credit research analysts, and portfolio managers explicitly dedicated to their sector of the market sit together to discuss and implement their views in the portfolios. Our team's capabilities span the investment universe, from government securities to corporate bonds to emerging market debt. This helps us to meet our clients' diverse risk and return needs. When our teams step onto the trading floor, they know they have an advantage over fund providers with higher costs and outside interests. Our client-owned structure and lower costs serve as tailwinds to the active portfolio management teams. They have the flexibility to take risk only where the portfolios are appropriately rewarded. They also follow a long-standing, disciplined investment process with an emphasis on mitigating downside risks. We believe bond funds shouldn't surprise you or your clients, and our goal is to provide consistent outperformance regardless of the market environment by leveraging our diverse set of strategies. This culture of smart risk-taking and collaboration is a key differentiator for our active management process. We don't have star managers. Our active management team is a global network of experts who work together to deliver competitive, risk-adjusted returns for your clients over the long term. I hope you enjoyed this quick tour showcasing our active fixed income capabilities. Thank you.
Okay. And the last slide I have is to show you the different investment management systems. So at the top left, this is where I'm looking at my portfolio. It's called Portfolio Construction View. So I'm looking at different views, FX view, hedge view, security view, and so on. So I can pick which view I want to look at my portfolio. And I'm looking at my portfolio in real time. So I have a team of portfolio managers globally, and whatever changes they're making to the portfolio in terms of buying and selling, I can see that in real time on my screen. And in the top right corner of the panel, I can see the currencies or FX because my portfolio managers and traders are buying in different currencies across the globe, like in Aussie dollars, Japanese yen, euros, and so on. I can see all in real time what is the sum total of the buying and selling in each currencies, because I need to have that currency, or some FX trader for me will buy and sell that currency. So the blues are positive and the reds are negative in those different line items. And in the bottom left panel, I have a dashboard of all the orders that are sitting either to be executed or trades that have been filled and have come back to the system. So some portfolio manager has raised an order, so it'll be sitting in the queue and for the trader to pick it up and send it for trading, or trades that have been executed and come back and are sitting in the portfolio. So that's a dashboard of real-time orders and trades that have been done. And then, most importantly, I have to look at my profit and loss, which is the portfolio attribution, which is after all the trades are done, in real time, I can assess the P&L or attribution of my portfolio. So that's kind of like an idea of giving you a sense of how the different investment management systems are used. So that's it, and I would love to welcome your questions.
In the first video, you mentioned about the CME group being the central counterparty. Is it government backed? I mean,
No, it's a private exchange. It's one of the world's largest exchanges.
so then how does that reduce the risks of because being the central counterparty, it would also entail some system risk, right?
That's true. It does entail systemic risk, but it does clear both sides of the trade. So a buy position and a sell position. So its own risk is flat, meaning offsetting risk is zero. But you're right. This is actually most exchanges are globally systemically important to the financial health of global financial stability. So they have to put up a lot of capital and they're regulated by the government. Yes, sir. You have three questions? Wow.
Firstly, sir, I would like to ask why is futures market in India not so well known as the stock market compared to the stock market, not so liquid and people are not also. Is there a reason for that?
I don't know the right answer, but let me guess. I think futures generally are viewed with a lot of skepticism and caution by governments across the globe. In developed markets, they are known for risk mitigation and risk transfer, and the markets are well developed and regulated. And I don't know the reasons why the futures market is not as active or efficient in India, but that perhaps is the reason. Years, it's quickly catching up in the fixed income world.
In US, it's very much like in the US market in CME and all, it's very active.
Correct, yes. So my team of traders, they use algorithms for trading. Your question was how long will traders remain gainfully employed? The days are nearing very fast. Like I would say another 5-10 years. So it would be completely automated.
I have personally traded in Brazilian markets.
Sorry?
I have personally traded in Brazilian futures market, interest rate.
Okay.
So what do you do in case a big buyer comes and it just, or a seller comes and it puts down the price, which you don't think, like you think that 5.5 is a good sell price and it comes and sells 5,000 and distorts all the spreads and flies. So what is your strategy in that case? You stay away from it or you enter it?
So you talking about execution strategy or portfolio strategy?
Portfolio strategy. So what are your views like? Do you stay away from that if all the prices are distorted, or you play?
So if there is a market correction, like a massive correction, when uh, the cash or derivatives market there's a sudden drop or sudden rally, like massive uh, uptick. So in those markets you have to be really cautious. Like you cannot fool around. That's a time for understanding what's going on in the market, because you may get hurt unintentionally. So that's when you are cautious, and if you're algorithmically trading, those algorithms will catch that. So they'll detect a market correction. In fact, there are many exchanges and trading venues have something called circuit breakers. So if the market drops by X percent, they will halt all trading. Just because it could be a faulty order or um, a manual error from a trader somewhere in the world, and it happens not that often, but once in a blue moon it does happen, and it creates um, an environment of panic and chaos. Those are your three questions. You're done? Happy? All right. Yes, sir.
So as you mentioned, LIBOR benchmark will be there only for a couple of years, then what will drive the yield on the market after LIBOR is gone?
What will replace it? So different countries are adopting alternative risk-free rates. So there's private public sector partnership across the major developed markets. So in the US, something called the Alternative Reference Rates Committee, which is comprised of private sector participants, and they have picked something called SOFR, Secured Overnight Financing Rate, which is an overnight rate, and that's based on the repo market, and that will replace LIBOR, and that actually started to happen. So we are already trading SOFR and starting to look to reduce our LIBOR exposure because LIBOR will end in December 2021.
A very basic question.
Yeah, what?
I have a very basic question.
Okay, I may have a basic answer.
As an asset manager, do you look to only get down prices or only open the
Do I look at the delta on price, or what was the other alternative?
do you look at the delta on prices or do you look to only open on the security? I mean,
Open on the
on the
security.
20, if it's a 10% security, you like to use on the open rate 10% on that, or do you want to earn the differences on the prices of the?
What do you think is the answer?
So it depends on the intention as well. I mean, if you want
Okay, let's say my intention is total return. I want to maximize my portfolio's income.
in that case, trading on the prices.
Exactly. So I'll do both.
So, okay, so
The basic answer is both. Yes.
So, but you particularly portfolio in that terms, I mean, for a longer risk-free, less risky portfolio, do you invest for the open and for active management, you trade pricing?
So our firm, Vanguard, is only active management. So we care about generating profits any which way. So whether it's from the interest income or from price appreciation. There isn't segments or pockets where it's active, non-active, it's all active. There are other investors, not my company, like insurance companies, they are buy and hold. So suppose their liability, it depends on what your objective is. So insurance companies have long dated liabilities where they have to pay life insurance after 30 years, let's say. So they'll buy 30-year bond and sit on it. Like they won't trade it because their objective is different. Our objective is to generate profits for the
In the equity segment, Vanguard has been always local and passive kind of investment.
Right.
Do you think those trends coming up in fixed income near soon, or is it a different market altogether in that?
Sorry, I'm not understanding your question. Is fixed income market different than equity market?
Equity market in the sense that in equities, Vanguard has always been
A dominant player.
dominant player in the passive investment.
Correct, that's true.
So how does that differ in the fixed income markets?
So Vanguard manages roughly $6.2 trillion, out of which 4 trillion is in equities and 2 trillion is in fixed income. Of the 2 trillion in fixed income, half of it is passive and half of it is active. The 4 trillion equity is all passive. Does that answer your question? Vanguard is trying to become a dominant player in active fixed income. Our unique selling point is that we offer fund management, whether it's passive or active, at very low fees because of our scale. So we manage, like I said in the video, it said, we manage 6.2 trillion with only roughly about 400, 500 portfolio managers and traders.
Basically, there are inefficiencies in the fixed income market that can be activated. Is what
Absolutely brilliant question, and the answer is yes. Equity market is highly, highly efficient. It's very difficult to be an active investor and beat the benchmark. Yes, and in fixed income, it's a lot of inefficiencies. You know why? Because a lot of investors, they are buy and hold. Central banks are buy and hold, and they are acting based on a lot of other things other than profit generation. They have mandates for holding X amount of capital and so on and so forth. So they are kind of, we call them irrational investors. Like central banks, they'll just buy trillions of dollars of assets and sit on it and do nothing. They're not, like someone was asking, like, are they trading based on price going up or down, and they're not. So because of that, I can sniff that out and find that inefficiency, but still very hard to generate profits in active portfolio management. Yes, sir.
So in equity stock, particular company you just have one stock issue, but when it comes to debt, company can have multiple issues.
Correct.
Only per track, which is attractive, and something like recency bias might be playing important. That more recent issue might be more liquid, so people are attracted to that. But is there a, so as an active manager, do you try to find value in certain issues which were issued previously, but it has certain values? How do you think that will?
Brilliant question. By the way, you're absolutely right. There is a recency bias. So newly issued are more liquid, and the bid offer, the difference between buying and selling prices are tighter, as opposed to something which was issued 6 months ago or 1 year ago. The bid offer and liquidity is lower, so there is some seasoning aspect to it, and seasoned securities are less liquid. Hence, the bid offer is wider. The markup is wider. So generally, traders try to stick to new issue securities to, so there is a illiquidity premium in seasoned bonds. Absolutely there. Yes, sir.
So, like recently we've seen the trend of negative interest rates, as well as companies like Apple actually going out and issuing 0% bonds in Europe.
Correct.
So, could that trend actually increase to such an extent that most of the developed markets enter a 0% or a negative interest rate, and for at least a brief period, the bond markets actually do not have a lot of demand for it, considering the investors don't get any yield on it?
So the answer is yes. Yes. Right now, the total bond market is roughly $85 trillion. Out of that, 13 trillion is negative yielding, so it earns negative rate of interest. Now, from an issuer standpoint, its advantage is to issue debt yielding zero or negative, because you're actually getting money to borrow. You're being paid to borrow money. That's like heaven sent. But think of it from an investor standpoint, like why would you lend money and have to pay to lend money? Can you give me a reason why? Okay, so the reason why anyone would invest in negative yielding securities is that there's more demand than supply, right? So I want to own Apple debt because I deem it to be a better than some other alternative. So there's much the demand. There's actually an issue in terms of the credit quality of debt, because is a good company and will be around for next 10, 20 years, so I can get my money back. But the spread or the earning on the bond is negative or zero, so I'm not earning anything. Back to your question. So why would I buy it? Because I have no other alternative. And investors that are buying my funds have come to expect that too. And why are they putting money in my bond fund when they can invest in stocks? That's a question.
So, like they could ideally invest in an index fund and get better returns, and with a lot less risk on it.
Correct.
Considering, for example, if they buy an S&P 500 index fund
Yeah.
versus in any of the bond markets.
Right.
So, considering that the risk is a lot more diversified and it's 500 stocks, and it's more likely to stay around, they would get better returns and get their money back.
So why are they investing in fixed income? So I'm asking you.
No, no, even that.
So the answer is because there's a lot of different types of investors. Obviously, those younger, it depends on the demographic profile of the investor. So younger investors tend, in general, to have more less aversion to risk than older investors. So someone who is 80 will have less tolerance for risk than someone who is 25. So the younger people will invest in risky assets, and the older people will invest in less risky assets. So that is one answer. Like people generally that are retired, they don't want to take risks in the stock markets. They will generally invest in fixed income assets. So it depends on the investor profile, but there are reasons why investors will continue to invest in negative yielding credit.
So you mentioned that the fixed income markets are more inefficient as compared to the equity markets.
Correct.
And you also like more opportunities to make money. And you also mentioned that the retail participation is very low.
Very good, yeah.
In fixed income as compared to equity. So what,
Even in equity, I would say it's low, but in fixed income, it's much lower. Yeah.
So what would be the reason for this, like the retail participation in the market? That's
Sure, I don't know the answer for India, but let me give you the reason why it's in US. So in US, investors, let's say there is an investor who has $5 million net worth. In one single bond, how much do you think they'll buy or sell?
larger amount.
Let's say they buy $100,000, right? I'm an institutional portfolio manager. I manage $140 billion. One single trade of mine is $200 million. Who do you think will get a better price? $200 million or someone buying 100,000? So the institutional investors dominate the market. It's maybe 95% of the market. Retail investors cannot. They actually put money in our funds or our competitors' funds. I don't know the answer to the Indian market. Is retail participation high in India?
Very low, very low.
Right.
Especially in fixed income.
Right.
Through institutions.
Yes, they're largely through institutions.
And we have mandatory investment, banks, they have to put mandatory investment, insurance companies mandatory investment.
Right.
So we have a captive investors we call it.
Exactly. Right. That's globally true.
Yes.
Yes, sir.
I have a follow-up question to what all the students asked. I'm very curious to hear your thoughts on this. So there's this general understanding that there's some limitations to monetary policy. You mentioned it in your points that research also looks to monetary policy, central bank policy, etc. But I think there's been more debate in the last 2 years about reaching the limits of what monetary policy can do.
Yes.
And whole monetarism is a big question. Would you say that as a practitioner, when you look at the research side, you see action shifting and likely to stay away from monetary actions to more fiscal, things what the government is doing in terms of impact on rates for the medium term? Has action shifted and has that shift reduced?
The answer is yes. So again, I invite you to the evening session where I'm talking about this topic. But okay, sorry. All right. Okay, fine. So let me cut to the chase. So the answer is yes. So for the past decade or so, there was severe monetary policy intervention by the central banks. After the financial crisis, where they tried to fix the economies that had completely collapsed after the crisis. So there was unorthodox and unconventional monetary policy intervention by way of cutting rates almost to zero. In case of Europe, they cut it down to negative 50 basis points. And also quantitative easing by way of buying assets. That has reached a point where they don't have any more tools in monetary policy tools to address the weakening economy. Like Europe, there is no further rate cuts possible. Like they have run out of tools. So they are looking. The markets are looking for fiscal stimulus from like the German government to spend on infrastructure and so on. Even if the German government is not willing to do that, but they will be forced because ECB has run out of bullets. Exactly, and so in the US. Easy to. Yeah, so the challenge with fiscal policy is very hard to discern. Like administrations come and go, central bankers stay, for right. So one is elected government, one is obviously non-elected. So um, it's easier to understand monetary policy than it is to understand fiscal policy, and it depends on a lot of things in the political sphere. Generally, politics is much difficult to understand than monetary policy. But the answer is yes. There's a pivot from thinking solely about monetary policy to thinking about fiscal policy.
The same situation in Japan for quite some time.
Yeah, exactly. Yes.
Sir, if you could comment on the recent yield curve inversion, like is there any macro fundamentals which market is not able to look for the reason behind the yield curve inversion? And like also because most of the macro fundamentals are suggesting that the economy is doing well.
Which economy are you talking about?
US
Yes. So that's a great question, by the way. So, and it is inverted. Right now, it is inverted. So the 2-year is yielding more than the 5-year, and so on. So the reason for that is that the um, the outlook for long term is not very robust or strong because of the trade wars the US has ongoing with China, the growth scares from China because of the pandemic situation, um, the kind of the decline in multilateralism across the globe, and so on. So the long-term prognosis for the US economy is not that strong. In the short run, the economy is doing well, but everyone's aware of the business cycle impact and what it'll have in in the years to come. So the short-term economy is doing well. Rates are high. It's roughly 1.4%. The 5-year is 1.35%, etc. So it's inverted. So inverted yield curve meaning recession is likely to happen. Great questions, by the way. Meaning you guys were paying attention. So.
How important is the volatility index in trading? The VIX.
Sorry?
How important is the volatility index, the VIX, during trading?
So VIX is in part of the equity world, not in my world, but it's people monitor it to gauge a sense of the uncertainty or investor uncertainty in the market.
So the Indian Central Bank is speaking aggressively when our basics are listed on indexes.
Sorry, can't read.
So the RBI is pushing that the government securities are listed on global indexes. So the funds which are mandated to track the global index will have to fund in government securities of India. So for an emerging economy, what happens when such a move happens? So we are attracting a lot of passive investments from fixed income money.
Yeah. So your question is what will happen? So this right now we're having this with China. So China has been included in the global bond index. So all the passive investors have to invest in the Chinese market. So the impact that will happen to the local Chinese market, bond market, is that will become more efficient.
In terms of banking liquidity, instability, or providing high interest rates,
That depends on a lot of other macro factors than just the inclusion in the index. But it does open up the local industry, local markets to passive investors. Yeah, but there's a lot especially with the inclusion of China in the global bond index. It's not just as simple as including in the index. You have to provide investors access to the index. So if it's just included in the index and the Chinese government doesn't allow investors to invest, then it has no meaning in just being included. So the markets have been working on something called Bond Connect between Hong Kong and the global investors. So you can access the bonds. There's something called Stock Connect and Bond Connect, which connects the global markets to the Chinese stock and bond market. So there's a lot of infrastructure and ecosystem has to be built before a country can be included in the global bond index.
We saw the countries which analyze tradings. India is one of the
I cannot speak for my CEO, but as far as I understand, they want to go where there are large opportunities for large asset managers like India. I mean, like Vanguard. So we are dominant in US and Europe and Australia, which is where the money is. So they want to go where the money is. We are trying to break into China. Chinese market is very hard to break into for asset managers. In the sense of the development of markets in India and the role of asset managers, it's not. I mean, the largest asset manager in India manages 65 billion. Several of our portfolios are larger than 65. One of our portfolios is close to $1 trillion in stocks.
Kind of getting to some time.
All right.
So I'd like to thank Dr. Sam for being here and addressing you guys. Very good overview of the fixed income market, US, and excellent question answer session. Really enjoyed it. Right. So thanks to all of you as well for taking time out and coming with such nice questions as well. Positively surprised on that. I'd especially like to thank our faculty members for being here, economics and finance both, and participating in the session. And we have a small gift for Dr. Sam and
Thank you. Thanks for all your questions. Thanks for having me.